Welcome to episode 220 of The Numbers Game. I'm Jace. I'm here with Nick and Marty, and today, off the back of a couple of great episodes around commercial property and all things retirement and passive income, I want to talk to you about how you can buy a property with your super fund. Nick, Marty, what do you reckon? Good strategy? You guys hearing a bit about this at the moment?
Yeah, more than ever lately. It feels like there was a wave a few years ago. That wave stopped, but it's back, both from a lending point of view and a financial planning point of view. Lending, obviously, people leveraging to buy, but a lot of requests from good people like yourself, Jace, for assistance to set up self-managed super funds. And I'd say the last 12 months, it's really spiked. Marty, what do you think?
Yeah, exactly right, Nick. I think there's just an appetite for better vehicles to purchase property in. And, people just see property, obviously, as a great vehicle to make money in the long term. And, I think people want control. They want the tax benefits, and they're talking to their accountants a lot more about it up front. And you're seeing it even in self-managed super funds, just with shares as well, people wanting to control the assets. So that's it's definitely an upward trend. And the major, interestingly enough, I don't know whether it's compliance or regulation or whatever, but the major banks sort of pulled out of funding a lot of the self-managed super funds. But there's other organisations out there that will do it. And the only ones, like most accountants can't understand why the banks have pulled out of it. But there's lots of other alternatives, and it's a relevant space.
Well, Marty, I'm glad we've got you on this show because there will be a few times I'm going to throw to you guys to unpack a bit of this. And the lending one is definitely a bit of a curveball around it, but we'll get to that. So the other one here that I want to touch on as well, which is a big one at Future Advisory and for a lot of our clients, is also how you can rent your own premises to yourself. So, you might think that, you're renting an office or you're renting a commercial facility like a factory or a warehouse, and you're paying someone else. We talked about it last episode, like how good the commercial yield is and how much money, someone who owns a commercial property can make. So if you've rented a commercial building and you're a business owner, there is also a way that you can then use your self-managed super fund. Nick talked about the $1.5 million factory or property last episode, but needing a 30% deposit. And some listeners might have been sitting there going, well, geez, how am I going to come up with 30% to buy my first commercial property? This is then also where you may have enough money between yourself and your partner to be able to roll that into a self-managed super fund. And all of a sudden, there's your 30% deposit on that commercial property. They're still roughly the LVRs that we need to know, Marty and Nick.
Yeah, around that 70% mark. I've seen one lender sort of stretch to 80, but they're generally the best pricings around the 70 mark.
Yeah, awesome. Well, Nick, I think given your financial planning background, I might get you to give me a bit of a run through around, what is a self-managed super fund? How does that differ to a normal super fund? And then I can go into a bit of what it's like to set it up.
Firstly, I don't like the word self-managed.
Good.
I think it's the wrong. I see self-managed super fund as a vehicle to access asset classes that you couldn't access through a normal super fund. So obviously it was intended for self-managed, but where we've seen things go is, okay, I want a self-managed super fund because I want to buy a property. I can't do that through Australian Super. I can't do that through Vic Super or CBUS. It's, for most people, it's not, I want a self-managed super fund because I want to manage my own money. The reality is that most people don't have the skill set to manage their own money, and they'll put their hand up and they'll admit that. So a self-managed super fund allows you to buy assets such as properties, probably the main one, both residential and commercial. Some other cool things in there, like around artwork and collectibles, I would think, Jace, that you can also buy. Cryptocurrency. So you've just got access to do things that something like an Australian Super or a Colonial First State won't let you do. A normal super fund like that, you're generally stuck with ETFs or managed funds or shares. And that particular provider, such as a Colonial First State or a Macquarie or a CBUS, will manage that money and give you a return. For most people, that's a really good solution to super. If you do want to buy a property, you need to go down the self-managed path because obviously CBUS won't go out and negotiate. Keep talking about none and wadding, Marty. CBUS won't go out and negotiate a purchase in none and wadding for you. So if you do go down that path, the self-managed super fund path, there's a lot of regulation that needs to be adhered to. That it's a lot harder for the ATO to be across the regulation on a self-managed fund than it is to say to someone like CBUS, you need to tick this box, this box, this box. So when you have a self-managed super fund, you need to get an accountant involved. You generally need to get a financial planner involved to make sure that you understand why you're doing it, the pros and cons of doing it, and ultimately, is it the best solution for you based on your goals and objectives? So I didn't really explain what one is, but I guess what I did is explain why people are setting them up versus going to a normal fund, which I probably think is more of an appropriate answer.
I've always wondered whether it's, I suppose it comes down to your goals, at the end of the day, but I'm thinking, what about keeping a dynamic asset outside of super if you're buying your own commercial property, as opposed to putting it in super? Because again, when it's outside of super, you could probably leverage that property to buy other assets, whereas when you put it strategically in super, you've got the tax benefits available to you for the longer term. Is it just an individual basis, Nick, from what you see, depending on the goal of the client as to what you would do?
You've nailed it, because if your strategy is to continue to grow a portfolio and use that equity to buy more, then you cannot do that in a super fund. You can pay it down. That's about it. But if your strategy is buy and hold for retirement, and I don't want to buy any more by using that equity, then for me it's super every day of the week, because it's 15% tax. It's tax free when you reach retirement or preservation age. And then second to that, you've got access to deposits inside of super. A lot of the times the cash flow is easier because you've got your superannuation contributions going in there to fund it. The other thing I will say, just on self-managed super funds, just to finish off the question you asked, Jace, is again, the reason I don't like the word self-managed is because a lot of people that have self-managed super funds actually have financial planners managing that for them. Again, quite often we'll have clients come to us that will say, I need a self-managed super fund because I want to buy a commercial or residential property. That's great. But what about the excess cash that's going to be left? How are you going to invest that? Well, I need help. So a lot of the times we'll have clients that we're managing their self-managed super fund for them, where they'll have a property over here, but we're managing the liquid assets, which could be shares or an ETF. We're also managing the overall strategy. So is your strategy to pay that property off? You want to pay it off by retirement age, and you want to have this much liquidity in there? Who's monitoring that? So again, getting away from that self-managed word, because I really don't like it. In most cases, they're not self-managed.
No, I think it's a really good one to hit off for those that have landed here and thought, yep, I want a self-managed super fund. I want to be able to buy a property. It's then getting into that detailed stuff. So, got a couple of $1,000s to set it up, depending on if you need a bare trust or not, without going into too much boring detail. But a bare trust is an extra setup cost if you are going to borrow from a bank to buy property. So, you're probably looking at anywhere between $3,000 and $5,000 to actually form a self-managed super fund. Then you also need a statement of advice from a licensed financial planner. So you're looking at another couple of $1,000s. Then every year you got to pay the accounting fees and the audit fees. So while it is a self-managed super fund, as Nick's touched on, there's a lot of external parties that are involved along the way of making sure that your self-managed super fund stays compliant. So, we bring all this stuff up front that, if you are thinking about it, you've got to then go and do the research and look into how, when, where, why, and what am I going to have to do when I do set it up. But obviously, like everything, as long as it forms part of your strategy. If part of your strategy is, I don't want to give $60,000 to my landlord anymore and I want to own a commercial property in my super fund, great. And it might not just be about buying a commercial property in your super fund. It may be also other residential property. You may not have residential property in your own name and you want to diversify by having some in your super fund as well. They're the kind of things that obviously the meeting with a financial planner can help you unpack. But it does just allow, that money that you've accumulated over time in your super fund. If you are sitting on actually, Nick, I might throw to you one more time and we'll get Marty involved shortly. But, there's always been a bit of a guide about what's the minimum you should have in super before you even consider a self-managed super fund. Do you have any kind of thought or opinion there?
Yeah, I do. In recent times, it was. Then this is guidance from the ATO. It was up around 500k.
Yeah,
and that is still very much. If you talk, the old school. I'll say old school belief is that 500k works. But that's purely on a cost benefit. So when you're looking at, do you pay someone to manage your shares versus, you could probably get a cheaper option if you didn't have a fund manager in there. So, but again, most people don't have the ability to do that. If we look at why people are opening self-managed super funds, in my opinion, 99% of the time it's to buy investment property. I'd say 250k. 250k will get you into a 700k investment. This is not advice, but
yep.
The question people ask is, how much do I need to buy a property? So the answer to that is around 250.
Yep.
Now that's still not going to be ideal, because that means you're going to have all your eggs in one basket, which is the investment property. You're not going to have much liquidity, and you need liquidity. So if I'm putting on my financial planner hat, I'm saying 500k makes sense. If I'm putting on the client's hat and it's how much do I need to buy a 700k property, I'm going to say, well, your 250 will get you there.
Jace, if you're buying a commercial property to operate your business out of, in regards to the rent you technically pay yourself, is there any, what are the regulations around? Does that have to be like a standard rack rate? Can you pay more into that property because you're making money through the business? What's sort of the criteria around that, just to sort of give the audience some parameters?
All very tightly managed and ran, so you need to make sure that it's a arm's length commercial market rate. So you need to go to a real estate agent and get an appraisal on the property. If you are paying well and truly above market rate, obviously that would seem like a pretty fun, shifty way to get some extra money into your super fund, get it taxed at 15 cents to the dollar, happy days. But yeah, this is the whole reason there's auditors involved, and a process with accountants doing your financials, and then an auditor going through it. And like when this is an auditor's job to make sure that the fund is compliant, and one of those things will be making sure that market rent is paid. We've had clients that have bought residential property before and then tried to use it themselves when it wasn't being rented out on like a Airbnb or being managed by a property manager. And, it's a big no-no. It's called the sole purpose test. And the sole purpose of your self-managed super fund is to provide retirement benefits. The members of that fund cannot get any benefit from that themselves, where then that is confusing with, well, then how can, the business owner rent their own factory back to themselves? It's generally arm's length because of the company the business owner is running. So it's the company renting the commercial premises, and that company has an arm's length agreement to be paying the rent to the self-managed super fund.
That's a really good point. I just want to jump in there because
please,
it's a really important factor with self-managed super funds. The government loses control versus, I keep referring to a CBUS or an Australian super, for example. There's real tight controls there over what is done with that asset or those investments. And the ultimate goal of that fund is to fund someone's retirement. So your example there is great, because if you go buy a holiday house with that and it's not Airbnb and you're renting it out, you're using that money, or you're using your super money to provide a holiday, hypothetically. Versus if you're running your business out of it, your business is still paying a market rent. Again, must be market, because it's got to be, the goal is to do the best for the fund. Your business is paying a market rent into that fund just as any other business would, or just as your business would pay to another landlord if they went and rented someone else's property. So I think the ultimate goal is to provide for your retirement. And there is significant restrictions around making sure that happens versus using it for other benefits, such as a holiday house, which isn't funding your retirement or contributing towards your retirement.
Jace, what about improvements to a commercial property and residential property? Like, what's allowed in regards to maintenance, as opposed to, can it be developed for growth? These are all questions, no doubt, people would be thinking about.
Nah, very, very good question. So yeah, your basic repairs and maintenance and upkeep of the property, all fine. That's no issue. But property improvements to the point where you're, renovating and paying outside of the super fund environment to renovate, change the nature of the property, add an extra property to the back of, let's say, a residential property you bought, there's room for subdividing and developing. All absolute no-nos. You can't do it in the self-managed super fund environment, which again, this all comes down to making sure you've developed your strategy and thought this out properly. And again, talking to your advisors, whether it be your accountant, your financial planner, there's only so much accountants can comment on when it comes to investment strategy and financial advice. And hence, why we work so closely together, because it's great to have everyone's involvement from a tax consideration and the financial planning and advisory side, as well as, Marty, what you and the team bring with the ability to get the brokerage sorted and get the finance done on a property. So,
and thank you for that answer, mate, because like a lot of people get confused with that. Sometimes it's very... people just jump into it without thinking through the whole strategy piece, and then want to do these fancy things in developing the property, and it causes some great conflict, obviously.
There's all these different things to think about. If you do end up having great capital growth on this asset inside the super fund, now obviously a lot of people will get into this for passive income. They're paying the $60,000 they were paying to the landlord. Now they're paying it to their own self-managed super fund. They've also then got their own wage. Will be getting super contributions as well. So if you're a husband and wife that's gone and bought this property, but you're both still working salaried jobs, your contributions on top of the rent are also going into your super. You're paying down the debt on the loan that you've got to own this property. And all of a sudden, what should be happening is you're building your retirement wealth. If at some point in time you do need to sell the commercial property due to, sometimes there's liquidity issues, sometimes maybe you got another investment opportunity, you want to sell the property because you're no longer running the business, you've sold it and you don't want to keep it anymore. The other, upside here is as an individual, if you're selling in your own name, yes, you get the 50% CGT discount, but the remainder is often taxed at as high as 45 cents to the dollar on the capital gains tax. Capital gains within the super fund is 15% if you sell within the first year, or 10% if you sell outside of that. And then as Nick touched on as well, if you wait until retirement age, it's capital gains tax free.
I reckon let's just hone in on that, because that is significant.
That's the win.
If I'll throw an example at you, Jace, because you're the tax man. But let's say I am... let's say I'm like 180, earning 180 grand a year as a professional.
Yep.
I've bought a property, whether it's commercial or resi. I've decided to sell it at age 65. I'm still working because I've still got the ability to work. Assuming everything else is normal, but if that property has gone from a value of say 600,000 to let's be really realistic here, to 950,000.
Mm-hmm.
So that's a 50% gain over whatever period. What kind of capital gain am I paying?
Yeah, the difference there, I've done the numbers, punched it in for you. So 600,000 up to 950,000. If you own that in your own name, and let's assume you're on 190, because that's the new bracket now, and that'll make it easy for me. You're going to have a capital gain of 350,000, half that down to 175,000, because you still get the 50% CGT discount in your name as an individual, and then you're going to lose 45% of it. So you're going to pay $78,750 in capital gains tax.
Yeah.
Now, in your super fund, that would have been 35,000. So you would have.
What if you had hit preservation age?
Oh, well then it would be zero.
Yep. And preservation age is, I said someone in that's 65.
Yep.
So that's the biggest win. And that's why
even better.
If your strategy is to buy and hold for retirement, obviously you can't guarantee that's always going to happen, but there's also a much bigger chance of you buying and holding inside of your fund, because it's not hurting your cash flow outside. Like if you look at the reason people are selling, it's cash flow. You don't have that problem in your super fund for most people, because you've got your super contributions going in there and funding it. So there's actually a better chance of you holding that property to retirement if it's inside of your super fund. And if you're lucky enough to do that, then come to retirement when you need to sell it because you want to gain access to some of the you want to turn into a liquid asset. hypothetically, you're at preservation age, 0 capital gains tax. It's significant.
That's a massive win, point of difference. And Jace, if I want to go and work overseas and hold my asset in a self-managed super fund, are there any consequences to doing this? I'm just, as you can tell, I'm asking you all the questions I'm copying.
I'm pretty sure I've got Marty's next 10-year plan mapped out for these questions.
Look, that's that one. I can't give you the firm answer on that. I would say as long as your intention is to return to Australia, you can keep your self-managed super fund, but you would need to appoint a new trustee or power of attorney. So the members, if you are the directors and the beneficiaries or the members of the super fund, if you become a non-resident for tax purposes, I would say that would cause issues. This is all coming back to me on my SMSF study days. If you appoint somebody who's an Australian resident for tax purposes as your power of attorney and trustee of your self-managed super fund, all of the correspondence for that super fund needs to go through them. You can't manage it yourself while you're living abroad and doing things abroad. But as long as your intention is to return to Australia and take over managing your self-managed super fund, I would say that is okay. You wouldn't have to liquidate and sell it off if you do get that opportunity to venture abroad.
No, thank you. I got that question the other day, so I thought I'd ask one.
No, good question. I'm going to throw.
And I'm off to Dubai.
Oh, hey, I'm coming with you. That's all right. Marty, we'll throw one to you. I mean, look, let's just say, Dave, the tradie that we've talked about before, he's listening to this episode. He's getting pretty excited about, setting up a self-managed super fund and buying the commercial property that he's renting. How difficult is getting finance? Like, is this process more complicated than getting finance for buying a residential property, or what are we looking at here?
Yeah, it's probably simpler because you're going off, what's in the super fund, what's the income, the percentage of super going in off the wage and the rental. So as long as it stacks up to the criteria the bank's looking for to service it, it's pretty much set and forget. And because you require a bigger deposit as well, you're generally finding that 11% and the rental is giving it good cover. If you're trying to borrow and extend up to 80%, again, you got to cross the numbers and it depends on your income coming in, but you generally find at the 70% mark, 65% mark. Sometimes people come in wanting to borrow 50%. It certainly stacks up, but it's pretty set and forget. It's just because there's all the things you've talked about in regards to the setup. Sometimes you just need a bit more time. You need a couple of months to actually settle the deal, because there's a few more responsibilities and things you need to tick the boxes on as well. But the first thing is making sure it's the right strategy. So you talk to a financial planner at Innovate, you talk to the accountant, like good self, Jace, and then the finance piece is the final piece of the puzzle there. And look, there's a number of second-tier lenders that are very aggressive in this space, because the major banks are all, because the appetite's not there for the majors, they're all up around that 9.5% mark, and we're seeing rates somewhere around that 7.2% mark. So big savings on interest. And when you think about that compounding effect over years, that makes a significant difference to your retirement and what you keep at the end of the day. So really important, if you have got one in play on a property, to review and refinance and making sure you're getting the best pricing out there. And if you're setting up, you do all the right things, tick the boxes to get it set up, and then ensuring you're getting the most competitive rates in the market. It's about five or six lenders that are proficient in self-managed super funds on property.
Absolutely love it. Well, there's a reason there's a huge growth in the number of self-managed super funds. I think it's there's about 200,000 new super funds over the last 5 years, self-managed super funds that have been formed. So, we're hearing it, we're seeing it, we're getting calls and emails about it a lot. And, as you said before, Nick, I'm usually sending them your way anyway. So beauty of working together. If you have listened to this episode and you think, I'd love to own my own commercial property, but I've never had the deposit before. And, I've heard the barbecue talk of, this self-managed super fund thing, but never think it was realistic or possible. It may be, but you've got to have the conversations first. So look, we'd love to hear from you. We'd love to talk to you about whether it's possible or not. Reach out to Marty, Nick, or myself, and we'd be absolutely pumped to help you out and have a bit of a chat. Until next time, like, subscribe, jump onto YouTube and check it out if you haven't before. And I think we might even be able to be watched through Spotify now. So that's pretty cool.
Wow.
Until next time, though.
It's your super. Make sure it is. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.